So like a summary, like revisions, I'm taking you through this. Okay. So here I'll tell you where to focus more. Initially, you don't have much here initially. Some theories just to build the base, just to build the foundation, like for convictions. What is this financial statement analysis all about? That you may read, but that's very basic. You cannot expect any questions from all this. Financial reporting means what? Uh, Reporting means the way companies show their financial performance, as in how that reporting has to be done. So for example, as per IFRS, reporting has to be done using certain ways. As per US GAAP, reporting has to be done using certain ways. Okay, for example, LIFO is not allowed in IFRS. Okay, and so following the rules, okay, prescribed by the accounting standards, that is financial reporting. Then, so these are the accounting standards which are prescribing, forming rules. For IFRS, it is done by International Accounting Standard Board, and then for US GAAP, it is done by Financial Accounting Standard Board. Similarly, internationally, there are many other uh, regulatory authorities who meet as an international at an international forum to exchange their best practices. Okay, so there ISCO is one. ISCO means what? International International Organization of Securities Commission. That means here uh, all capital market regulators come and then they exchange their best practices. Okay, that is ISCO. So it is not a regulatory body. So this one you can remember. Why it is not a regulatory body? See, internationally, actually there is nothing to remember also here. It is again, just we have to understand that internationally there will be no regulatory body as such. Internationally, it is always, because regulatory body means what? It has to be followed, otherwise you will be punished. That is regulators. Okay, but internationally, nobody can punish another country as such. Okay, so so it's not a regulatory body, but then you can say like a group or association they are forming, and then they are exchanging their best practice, and then they recommend, they give directives. Directives means what? They give directions, guidance, principles, certain principles that other countries should follow, but nobody can force anybody. Okay, so this is the objectives of ISCO. Basically, the objectives is to protect investors. Okay, then here proxy statements means what? Proxy statements are issued to shareholders when there are matters that require a shareholder voting. That means proxy statement will have details about that voting. Okay, so that you can go through it and then you can take your decision. Okay, these statements are also filled with SEC. Okay, then here you should remember a couple of names. One is 10K. Form 10K means that is the name of the form for annual report. Here in India, we simply say annual report. Over there, they say Form 10K. Then here in India, we quarterly report we say, right? There they say Form 10Q. Okay.
Okay.
Then similarly, uh, S1 means S1 is this is the registration statement filed before the sale of new securities. That means before IPO. Before IPO, they submit some forms which is called as S1. Okay, which is detailing about the IPO. So it includes disclosures about the securities offered. Okay, so you can remember as before IPO, form S1, annual report is 10K. K stands for 1,000 year, and not 1,000, annual. K stands for annual report here. Okay, then Q stands for quarterly. Okay, then the rest all not required. You can remember 144 also. Form 144 involve the beneficial ownership of securities by a company's officers and directors. Analysts can use these filings to learn about purchases and sales of companies' securities by corporate insiders. No, not this one, this one. Form 144. A company can issue securities to certain qualified buyers without registering the securities with the SEC, but it must notify the SEC that it intends to do so. A company can issue securities to certain qualified buyers without registering the securities. See, ideally, if you are issuing shares to the common public, you are supposed to inform it to the SEC. You have to take their approval. Okay. Whereas if you are giving shares to some other qualified buyers means big investors. Okay. So in that case, you just have to, without registering with the SEC, you can still issue under Form 44. Okay.
Okay.
This Form 44 and then Form S1, 10K, 10Q. Only the names, if you remember, that is enough. You don't even have to know in depth as such. Okay. Then this one you can practically get it from the annual report also. You may pull out any annual report and then you may go through this MD&A. MD&A means management discussion and analysis. Basically, it will have the SWOT analysis of the management, the strength, weakness, their vision, how they are planning to achieve, and what are the challenges they are foreseeing for the coming year. So that you will find. That is called MD&A, management discussion and analysis. Okay. Then another one, this paragraph is important one. So after auditing an auditor, when an auditor can give an unqualified opinion or qualified opinion, adverse opinion, or disclaimer of opinion. Okay, and the one that is most preferred is unqualified opinion, because unqualified opinion means what? That means all accounting has been done properly. All accounting has been done properly, and no changes are required. Okay.
Okay.
Okay. Whereas qualified means certain changes has to be done, certain mistakes you have made, but the intention seems to be all fine only. Adverse opinion means the intention itself is wrong, seems like you have tried to manipulate things deliberately. Okay. And then disclaimer of opinion means the auditor himself is not able to provide any conclusions. Okay, so he's issued any opinion other than unqualified, sometimes called as modified opinion. If the auditor is unable to express any opinion, a disclaimer of opinion is issued. And any opinion other than unqualified is all modified opinion. Rest all are modified opinion. Okay, now this table is an important one. So US GAAP is developed by FASB, IFRS is by IASB. US GAAP is rule-based one. So rule-based one and IFRS is principle-based one. So one example is something, one or two examples that I can recollect is, say for example, under IFRS, research is research and development. So research is capitalized or expense. Research is expensed, and development may be capitalized. Maybe, okay, may be capitalized. Now, when it comes to US GAAP, US GAAP says research is expensed, development is also expensed. Okay. Research is expense, development is also expensed. So US GAAP is more rules oriented. Okay, why? See here, IFRS says you decide whether it is research or development. If you think it is development and if you want to capitalize, you may capitalize. So this is more principle oriented. Okay, principle oriented. And here right hand side, this says this is more uh, rules oriented. So be it research or be it development, you just expense it. That's what US GAAP says. Okay. However, for if it is software for sale to others, then in that case, research is expensed and development is also is capitalized. So that is only for software for sale to others. That means not in-house. So if ICICI is making some app for their own usage, then that will not be covered here. If Infosys is making some app, to sell it to somebody else, then that will be covered here. Okay, so this is one example. Another one also I can think about now. See, US GAAP and IFRS. So US GAAP, for US GAAP dividend paid will come under CFF. IFRS says CFO or CFF, you decide. Okay, that means it is what more principle oriented. It is giving you choice principles, IFRS. Then similarly, dividend received. Okay, it says CFO. Here they say CFO or CF. This is CF dividend received, no? So CFI. Yeah. Then interest paid. CFO or interest paid is CFF. Then interest received. CFO or interest is received. So CFI. Okay, so you see they are giving options more. Okay, IFRS. So this is more principle oriented. US GAAP is more rules oriented. Strict rules. Okay. These are a couple of examples. Now in inventory, US GAAP says FIFO, LIFO, weighted average, all are allowed. IFRS says LIFO is prohibited. Okay, in IFRS, this is prohibited. So this is an important one, memory-based one. So product development cost, US GAAP, they say expensed, like this one. Expensed. Whereas IFRS says it may be capitalized. May be capitalized. Okay. Then CFO, interest paid. So interest paid CFO, CFF. CFO or CFF. Okay. Then another one, yeah, reversal of inventory write down. So IFRS is flexible. IFRS says if you are doing some inventory write down, so inventory write down means now inventory is 100 rupees. Now it has come down to 90. So you are writing it down. So when you write down, so you are writing it down. Okay. Then after that, so in after that, if you think the price has gone to 100 and 105, now in US GAAP reversal of this write down is not possible. It is prohibited. Okay, once write down happened, you cannot change it. But IFRS point of view, you can reverse it. You can reverse it till the original cost. You can reverse it. Okay, till 100 you can reverse it. Okay. So IFRS is more flexible. This is okay. This table is fine.
Yes.
This table is also, yeah, this table is an important one. So this is the difference between capitalizing an amount and expensing an amount. Like, when you are spending money on something, you may expense it or you may capitalize it. And accordingly, all these ratios will get impacted. Okay. So here, so this is an important one. Um, when you are capitalizing, so the assets value will go up, because when you capitalize, this is balance sheet. Uh, so when you capitalize an expense over here, okay, so what will happen? The assets will go up. Okay, so assets will go up here. And then when assets are going up, so that means then in the income statement, what will happen then? In the income statement, expenses are coming down because you have capitalized. So if expenses are coming down, then the profits will go up. And this profits will be shifted back over here to equity. So equity will also go up. Have you understood this part? Assets and equities.
Yeah.
Okay. Then net income in the first year also is going up. Then subsequent years it will be lower. Why subsequent years it will be lower? Because you have taken a huge amount over here, capitalizing. So next year you will expense it slowly, like amortization you will keep doing. So next year, from this huge amount, you will take some amount and you will expense it. So for that reason, your income will come down next year. And the income variability will be lower. Why it will be lower? Because very slowly, year by year, you are expensing it, rather than taking one. If initially you would have expensed it, it would have been a big amount. Like, for example, imagine 5 crores you are directly spending and directly reducing, and next year no expense. Instead, what you are doing, you are taking 5 crores to capitalizing, and then you are taking 1 crore each year to expense. So income will be very smooth at that time. So income variability will be lower. Then return on assets, return on equity. So return on assets will be higher. Why return on assets will be higher? Because the return on assets, because the income will be higher. Okay, income will be higher. Why the income will be higher? Return on assets formula is, return on assets is equal to net income divided by average assets. Return on assets is equal to net income divided by average assets. Okay. Now here assets are going up and net income is also going up. Assets are going up, net income is also going up. Okay, when you capitalize it. When you capitalize it, assets are going up and net income is also, here I said net income is also going up only, right? But then the net income, the ratio point of view, see, when assets are going up, it will pull down the ratio. And when net income is going up, it will lift up the ratio. Now, between these two, which one will win? Because net income point of view, higher weightage will happen. So when higher weightage will happen, finally the numerator will win. Okay, why? Because numerator is a smaller number. Say, for example, normally if 1000 is the average asset, you will get something like 10 rupees as the net income. Okay, 10, uh, 10, or let's say um, let's say 50 as the net income. Okay. So out of these assets, 50 is the net income with 1000 rupees. Now, when assets are going up, say for example, if it is going up by 100 rupees, here income will go up by something like um, here also, if it is going up by, or let's say here it is going up by 20, here also it is going up by 20. So now numerator is getting more weightage over here comparatively, because you see this 20 in front of 1000 is a much smaller one. So initially, if you see 50 by 1000 into 100, just check this one. This will come to 5% return on assets. And then later it will be 70 by 1020 into 100. Check this one now. 70 by 1020 into 100. Hello?
Yes.
You are okay. You are not using laptop now, right? Okay. 70 by 1020 into 100. Yeah, I'll check.
6.86.
Huh. So that means overall it has gone up. Okay. So that's what it means. Same logic even for return on equity also, because equity perspective also, return on equity is a bigger number. So return, here it is written. So equity is, again, you may think in the same way. Equity is, something like 300 rupees is the equity, and 10 rupees return is 10 rupees into 100. Now you check 10 by not 10, let's say something like return is 50 na here, so 50. So it will be how much? 50 by 3. This gets cancelled. So 50 by 3 will be something, uh, 50 by 3 is how much?
16.6.
So 16.6 percentage. And then later, this return is getting added by 20. So 70 by 300. So now it will go even further. Okay, not 300, 320, because yeah, 320. So we are adding 20 both the sides. So again, the ratio will go up only. Okay. So that is the reason return on assets and return on equity is going up initially. Later year, what happens? Later year, because you will do more expensing, the profits will come down. And so the ratios are also coming down then. Then debt to equity, debt ratio means debt to assets. So this is simpler. Debt to assets means what? Debt to assets. So assets are going up, and so debt to assets will come down because debt is unaffected. So assets are going up, so debt to assets will come down. Then debt to equity. Okay. Yeah, and then debt to equity. So equity is debt to equity. So here also debt is unaffected. Equities are going up, and so debt to equity will come down. Okay. Then CFO will be higher. Why CFO will be higher? Because when you capitalize, you are not expensing. When you are not expensing, that means cash flow from operation perspective, it is a good news, because cash is not going down, so it is going up here. Okay. Similarly, CFI, because you are because you are capitalizing, it will be considered as investments. So when you are investing, there the cash is coming down. Okay, this table is fine.
Yes.
Okay, weighted average shares outstanding. So here you have to give weights uh, based on the time that they are there in the system. Okay, like for example, this is 10,000 shares outstanding from the beginning. So if it is from the beginning, then 100% weightage. So 10,000 shares. Okay, then it says on April 1, Johnson issues 4,000 new shares. So the financial year over there is from Jan to December. So Jan to December. Um, so Jan, Feb, March is over. April 1st onwards, that means 9 months. So for 9 months, what is the weight? So for 12 months, it is 100% weight. So for 9 months, what is the weight? So that comes to 75% then. So 75% of 4,000. So 4,000, that comes to 3,000 shares. And then July 1, Johnson distributes a 10% stock dividend. So stock dividend is issued even though on July 1. So here, because already I have taken weighted average on this itself, I can take. So even though it is given on July 1, I don't have to give 50% weightage, thinking that from July to December only 50%, because I'm already taking on the weighted average. I can directly, calculate here 10%. So 10% of this one, 13,000 is 1,300. So 10% of 13,000, 1,300 shares. Then okay, then on September 1, Johnson repurchases 3,000 shares. On September 1, Johnson repurchases 3,000 shares. So repurchase, right? So September, October, November, December, 4 months. So for 4 months, what is the weight? So that will be 400 by 12. So that will come to 33.33%. 33.33% of 3,000. So that comes to 1,000. So this 1,000 shares we will reduce. So overall, 1,000 we are reducing, 11,000, 13,000, 14,300 minus 1,000, 13,300 shares. This is weighted average number of shares. Okay. Then basic EPS is equal to net income minus preferred dividend divided by weighted average number of shares. Weighted average number of shares. So now this is the formula. Now based on this, you can change the formula. So if it is diluted EPS, so when they say diluted EPS, how you should do is, again you write the same formula as it is, divided by weighted average number of shares. And then if there is convertible shares which is getting converted, then plus, so when it is getting converted, number of shares will go up. So additional shares, because when you are converting, additional shares are getting created. Okay, but if additional shares are created, then you don't have to pay any dividend. So this dividend amount will go away. So this will be the formula when you want to convert preference shares. But if it is, let's say, again, use this as the base case. If it is bond, convertible bond, then how to do? So weighted average number of shares. So if it is convertible bond, then again I'm converting. So I will get additional shares. But if I'm getting additional shares, this preferred dividend is not there. So if it is not there, then it is 0. Okay. So here I'm converting bond, additional shares. So when I'm converting bond, so I'm going to get more, I mean, all that interest that I have been paying to the bondholders will be saved. So plus interest, okay, along with net income plus interest into 1 minus tax. Because this much money I'm going to save, it will be with me. Because when I will save all the interest, I have to pay more tax. So when I will pay taxes, remaining part only I'm going to save. So that's why the formula gets changed like this. Okay. Now suppose if in the sum they have both, imagine preference shares as well as a convertible bond, then how should you do? So in that case, you should do one by one. One by one means what? First you take preferred dividend and then see what is the outcome. If this outcome is lower than the basic EPS, if the basic EPS is 2 and this is 1.9, then it is acceptable. Okay, then you think that okay, this preference shares is convertible. If it is higher than that, you have to ignore preferred dividend. Then in that case, that means it is anti-dilutive. And here also, if convertible bond, when you convert, suppose if the answer is 1.7, then that means it is convertible. Okay, then it is convertible, uh, and that means this is also fine. Okay, so suppose if this is also more than 2, then this is also not convertible, anti-dilutive. So both will be anti-dilutive. Suppose imagine this is 2.2 and this is 2.3. So both are anti-dilutive. So the diluted EPS will also be 2 only. Okay, and suppose if this is the case, this is 2.2 and this is 1.7. So in that case, this preference stock is anti-dilutive because it is more than 2, right? It is anti-dilutive. So I will only calculate this part and my answer will be 1.7. Suppose if preference shares is anti-dilutive, so here it come, I mean, if bond is anti-dilutive, I'm getting 2.3. Okay, and preference shares is 1.9. Then I will focus only on, I will convert only this preferred stock and I will say the answer is 1.9. Okay, so finally, whichever is lower than basic EPS, only that I can convert.
Okay.
Okay,
Yeah.
then for warrant, it is little different. So for warrant, they would have given one exercise price. So if the exercise price is, let's say, 20, and if the stock price is more than 20, then only it is exercisable. So imagine if it is 25. So the stock price is average stock price, we have to take average stock price is 25. So in that case, uh, uh, I will assume that as if they are paying this amount to me. Okay, so if they are paying this amount 20 into 1 lakh shares, imagine 1 lakh warrant will be converted into 1 lakh shares. So I'm going to get this much warrant. So this much amount. So this much amount will be utilized. So this comes to 20 lakhs. So this 20 lakhs will be utilized. So when this 20 lakh will be utilized, um, okay, when this 20 lakhs will be utilized, um, okay, so imagine in the market it is 25 rupees. So for 25, 25 rupees one share. And so for 25 lakhs, for 20 lakhs, how many shares will I be able to get it. So I will cross multiply and I will get this many, let's say whatever number I get, or let me calculate only. This will be 20 lakhs divided by 25. So that will come to 20 lakhs divided by 25. That comes to 80,000. So these 80,000 shares will be bought from the market and given it to them. And remaining 20,000 shares will be created. So in that case, the formula will be only net income for the diluted EPS, net income minus preferred stock is 0 in this case, divided by weighted average number of shares. Weighted average number of shares. Okay. Weighted average number of shares. So now I will just add the additional 20,000 because 80,000 is already taken from the market. So remaining 20,000 is only further added. Okay, numerator point of view, no change. Here, assuming preference shares are not there, 0, and here I don't have to make any changes in the numerator. Okay, this is diluted EPS.
Okay.
Okay, so this is all. You want me to do the sum here? Anything?
No, sir.
No, no. Okay. Then, because based on this, you can even practice all these sums. Then these ratios all, you should know all these ratio formulas. Then analyzing balance sheet. Okay. This line you can remember. This also fine.
So, what is internally created goodwill?
Internally created goodwill is expensed as income. Imagine you are doing some sort of research in your company, or your company is doing research. Okay, and you have created some sort of product. Now, if you have created some sort of product, that means now there is a demand for your company. Okay, now the goodwill of the company has gone up. But then where will you show that? You will not show in the balance sheet as my goodwill has gone up. You will, whatever money you have spent, that you have to expense as incurred only. That means your profits will come down. This way your tax will come down, but otherwise you will not show it on the balance sheet as goodwill. Okay. Say another example could be, imagine you are selling, you are having one tea coffee shop. You are selling it for 10 rupees. Then over a period of time, people like the environment and all, they are getting place to sit. You are incurring some amount so that they sit comfortably, they have coffee comfortably, they chit chat. So you are creating an environment. Now you are spending money, but the goodwill of the company is going up. Now people will think positively about your business, but then where will you show all that? Goodwill has gone up now, right? In comparison to any other tea shops, probably you are giving a better services. Okay, but where will you show all that you are incurring to increase the goodwill of the company so that people feel good? You can probably increase sales only, sales amount, instead of 1 minute. Instead of selling the tea for 10 rupees, you might be selling it for 50 rupees now. But that will go under sales, right? One sales, one teacup cost is 50 rupees. That's how you will say, right? You will not say my goodwill is, this much now. Is it okay?
Yes.
This one. That is called economic goodwill when you are selling it for 50 rupees. Okay. But that also will not be shown anywhere. Then yeah, here the form, the table you have to remember. This is held to maturity, available for sale and trading. So here balance sheet, income statement, OCI. This is amortized cost, realized gain or loss, and then this is nothing here. Here fair value. Fair value means market value. Here realized gain loss. Here unrealized gain loss will come here. Then this is fair value as in market value. Realized gain and unrealized gain loss will come in income statement. Okay, so based on this only, all these are there. So this sum is based on this part. Okay. Then yeah, these are all important one and easy one also. So liquidity ratios, current ratio, quick ratio, and cash ratio. Okay, so current ratio is current assets by current liability, but you should also know the heading. Many times people will focus on the formula, but they will forget the heading. You may get questions where heading will be the answer. Okay, heading means what? This liquidity ratios. So liquidity ratio covers all this. Okay, so what is the difference between current ratio and quick ratio? In quick ratio, current inventory will not be a part of it. Okay, inventory and prepaid expenses will not be a part of it. Okay, and then what is the difference between quick ratio and cash ratio? In cash ratio, receivables, inventories, and prepaid expenses will not be a part of it. Okay, so this is the formula, direct formula that you have to know. Then solvency, again the heading is important. So liquidity is for all short term liabilities, are you able to meet or not? So short-term obligations. And solvency is all about long-term obligations. Okay. So these are the formulas. From this, financial leverage ratio is very, very important one. Debt ratio also you can remember. These two, anyways, the name itself is saying long-term debt to equity. So long-term debt to total equity. Total debt to equity, total debt to total equity. But these two becomes then important because it is not clearly giving the idea. Debt ratio means debt by assets. Financial leverage is certainly very important because it is used in DuPont analysis. Then cash flow statement. So here I'll quickly tell you the format for direct and indirect method. So for direct method, see, first of all, cash flow statement comprises of cash flow from operations, cash flow from investments, cash flow from financing. Now, cash flow from operations can be done using direct method or indirect method. Okay, and for CFI and CFO, there is only one method. Okay, so first of all, direct method. CFO. So here it will be cash received from customers minus cash paid to suppliers. Then minus cash paid as salaries. Salaries are operational one, operational work. Salaries, wages. Then minus cash paid as interest. Then minus cash paid as okay, interest, then tax, then CFO. Okay, so this is the format for direct one. And further, if we elaborate, cash received from customers. Okay. Cash received from customers will be sales, then plus decrease in account receivable, right? That also you have received. Then plus unearned revenue. That means prepaid. Somebody is paying you in advance. So this is how we should calculate. Okay. Sales plus decrease in accounts receivable plus unearned revenue. The next one is cash paid to supplier. So that will be cash paid to suppliers. That will be equal to purchase plus decrease in accounts payable. Okay. Accounts payable. Yeah. And this purchase I can further rewrite as cost of goods sold cost of goods sold cost of goods sold plus cost of goods sold. Then what else will come? Inventory.
Increase in
Increase in
inventory.
inventory. Increase in inventory. Increase in inventory. Okay. Then plus decrease in accounts payable. So I can rewrite like this. Okay. Then next is cash paid as salaries or wages. So that will be, so here you can use this inverted Y method also. So even, yeah, even for, okay, even here, say outstanding salary or outstanding salary plus salary expenses for the current year. That will give you total. Out of that, you can divide that into two segments. One is cash paid as salary, and then closing salary. Opening outstanding salary, closing outstanding salary. So here it will be opening outstanding salary plus salary expenses minus closing outstanding salary will give you cash paid. Then next is interest. So same way, cash paid as interest is equal to opening interest payable plus opening interest payable plus interest expense minus closing interest payable. Okay, this is the formula. Again, same way you can write here, opening interest payable plus interest expenses, and here interest paid as cash and closing interest payable. Okay, then next is tax. Cash paid as tax is equal to, for tax it is opening tax payable plus opening deferred tax liability minus opening deferred tax asset. These three are one group. Then tax expenses. Okay, and then closing tax payable plus closing deferred tax liability minus closing deferred tax asset. And then cash paid as tax. Okay. So this is the formula. Now, if you want to write it like a formula, opening tax payable plus opening deferred tax liability minus opening deferred tax asset plus tax expense. Okay. Then minus closing tax payable plus closing deferred tax liability minus closing deferred tax asset. This is the formula. Okay, this is for direct method. Is it fine? Okay.
Yes.
Then for indirect, it will be like net income, start from net income, then plus all non-cash. So non-cash, add all non-cash expenses or non-cash charges. Depreciation is an example. Then deduct all non-cash revenue. That means non-cash revenue, because all these are non-cash related. So that is what non-cash revenue is. Non-cash revenue is revaluation of assets. Okay. Then plus non-operating. Non-operating expenses. So what is that non-operating expenses? Example, let's say interest paid. Now interest paid, imagine if your company is categorizing interest paid as if your company is following IFRS and categorizing interest paid as CFF, then it is not a part of CFO, right? So if it is not a part of CFO but it has been deducted in income statement, so I will add back. So interest paid, I will add back. Similarly, minus non-operating expenses, non-operating income. So non-operating income is interest received, same concept, interest received. Okay, because it is a part of CFI then. Okay, so all these will come from income statement. Then apart from that, current liability and current assets. So current liability has direct relationship and current asset is inverse, like, increase in current liability, I will add minus decrease in current liability. Okay, then add decrease in current assets minus increase in current assets. So this is direct. Direct means plus this increase and plus, that's why. And this is inverse. So these two are balance sheet item. Okay. So together, this is CFO, indirect method. Fine, okay.
Yes.
Then the sum is also there. Recorded videos are also there. Okay. So in case you want to watch anything, you just let me know. Okay. Then yeah, free cash flow to the firm. Another one is after this, free cash flow to the firm. So here the formulas are net income, then plus interest into 1 minus tax. Okay. Then my so plus depreciation, then plus interest into 1 minus tax, minus working capital investments, minus fixed capital investments. Okay. Then free cash flow to the firm will be EBIT into 1 minus tax, then plus depreciation, minus working capital, minus fixed capital investments. Okay. Then EBITDA into 1 minus tax. Here minus working capital investments, minus fixed capital investments. But one mistake here is we have to add depreciation into tax rate. Okay. Then CFO minus we have already deducted, so interest. So I will add back that interest. And then minus fixed capital investments. Now from this, if I want to calculate FCFE, so one is from free cash flow to the firm, another one is CFO. So from free cash flow to the firm, I will reduce interest now because I don't want that interest person. So minus interest into 1 minus tax, and then plus or minus net borrowing. If I'm taking more borrowing, it will be plus because more cash will come in. If I'm repaying the borrowing, it will be minus. And here CFO perspective minus fixed interest, fixed cost investments or fixed capital investments, plus or minus same way net borrowing. Okay, then suppose from this free cash flow to equity, I reduce minus dividend paid, and then plus issuance of equity. So I'm raising capital, or repurchase of equity. Repurchase means I'm paying. So this is called net change in cash. net change in cash. Fine, okay.
Yes.
Okay, we'll stop now here. We'll continue from this tomorrow. Okay.
Okay, sir. Okay, thank you, sir.